Hey everyone, and welcome back to another Noob Selling Options Explainer. I am absolutely pumped to have you returning today because we're tackling something literally every single investor wants, but hardly anyone knows how to actually pull off. We're talking about securing consistent, reliable weekly income. Today, we're going to break down exactly how you can systematically extract cash flow from the market without pulling your hair out over every little price tick, all by utilizing strategies that put you firmly in the driver's seat.
$788. That is the exact amount of weekly profit we've already locked in for the upcoming week ending October 7th, 2026. And honestly, the absolute best part of this whole shebang is that the money is already secured. It's essentially sitting in the bank right now, before the market even opens for the week. Let me show you exactly how we made that happen.
Okay, let's dive into this. We're talking about actual spreadsheet receipts here. This isn't some abstract theory. This is a fully collateralized portfolio with absolutely zero leverage and no naked risk whatsoever. We're looking at a highly targeted mix of cash-secured puts and covered calls across high-conviction tech and growth equities. And that specific mix mathematically locked in that $788 the literal second these contracts were executed.
Now, to understand how we can secure income so reliably, you kind of have to look at the two roles you can play in the market. On one side, you've got the speculative participant. And let's be real, that is a wildly stressful place to be. You're constantly guessing market direction, hoping the chart goes your way, and just panicking when it doesn't. On the other side, you have the house. Our strategy is entirely about acting as the house. We collect volatility-insensitive premium regardless of price action. Just like a casino relies on hard math rather than blind luck, we insulate our cash generation from those crazy short-term fluctuations. Whether the broader market moves up, down, or completely sideways next week, it doesn't matter. Our income is protected.
Let's break this down into our two main pillars to see exactly where that cash came from. All right, Section 1, downside buffers, specifically focusing on cash-secured puts, or CSPs.
This is the incredible mechanism we use to generate upfront income on the exact stocks we actively want to collect and hold in our long-term portfolio. So what actually is a cash-secured put? Well, I want you to think of it like being an insurance company. By writing a put, you're acting as an insurance provider for market buyers who are desperately seeking downside protection on a stock. In exchange for you taking on that potential obligation to buy the stock if it drops, they pay you an upfront, completely non-refundable premium. You are literally getting paid just to provide a downside buffer for someone else. How cool is that?
Now, what's really interesting about this slide is how the math plays out. For the week of October 7th, we wrote puts on three specific tickers. We've got CRCL at a $65 strike, DRAM at a $57 strike, and SoFi at an $18.50 strike. Just by opening those three positions, we immediately collected $269, $104, and $56 respectively. Add that all up, and boom, that is $429 in total, non-refundable cash banked instantly.
This sets up a beautiful win-win scenario for us. Because we're fully cash secured, meaning we have the cash set aside to buy the shares if we actually need to, there are really only two outcomes here. Step 1. If the market rallies or just stays flat next week, those contracts expire worthless. We keep the entire $429, our collateral is released, and we just deploy it again the following week. Step 2. What if the market drops below our strike prices? Well, we still keep that cash, but now we're obligated to acquire these high-conviction assets at a massive, predetermined discount. It effectively lowers our cost basis for long-term accumulation on stocks we already wanted to buy anyway. Like I said, ultimate win-win.
Okay, that covers the downside buffer and accounts for over half of our weekly income. Now let's jump into the other side of the equation. Section 2, upside monetization through covered calls. So while cash-secured puts are about stocks we want to own, covered calls are all about how we monetize the stocks we already hold. A covered call is basically an immediate yield enhancement layer right on top of your underlying equity performance. You're utilizing your current holdings, shares you already own in your account, to squeeze out extra yield. And you're doing it without introducing any structural tail risk. Because we own the underlying shares outright, there is zero naked risk here. We are simply getting paid a premium to set a sell limit order on our own assets.
And this brilliantly illustrates exactly what we did for the week. We wrote calls against existing equity positions in three amazing growth and tech companies. We wrote two contracts on Iron at a $46 strike, which collected $148 in total premium. We wrote a call on NOW at a $115 strike, bringing in $106. And we wrote one on PLTR at a $14 strike, securing another $105. That is an additional $359 generated for the week simply by leveraging the assets we already hold. Add that to our put premiums, and there's our total $788 profit for the week.
Just like with our puts, let's walk through the mechanics here because the outcomes are just so incredibly favorable. If the market drops or stays flat, these covered call contracts simply expire worthless. We keep the premium as pure net profit, we retain our shares, and we're ready to write calls against them all over again next week. But if the market has a massive rally past our strike prices, our underlying shares will be sold at those chosen strikes. Now sure, this caps our absolute maximum upside for the week if a stock goes to the moon, but it guarantees profit realization on those shares, and we still get to keep the full upfront premium. Think about that. Our absolute worst-case scenario is literally locking in a guaranteed profit on shares we wanted to sell at that price anyway. No way you can complain about that.
This all brings us to the core thesis of our strategy, and honestly, why the power of options is so incredibly liberating. Think about these three different market scenarios. Rally, our cash-secured puts expire worthless, and our covered call shares are sold at a solid profit. Drop, we buy high-conviction stocks at a steep discount while retaining our covered call premiums. Flat, pure premium retention across the board. The absolutely crucial takeaway here is that regardless of macroeconomic factors, regardless of inflation data or intraday volatility next week, that $788 premium remains entirely intact across all three scenarios.
Which perfectly aligns with this key quote straight from our strategy documents. Options transformation shifts the investor's role from a passive price taker to an active yield generator. I mean, that hits the nail on the head. That is the ultimate goal of the Noob Selling Options framework. We are completely escaping the emotional stress of daily market timing. Securing this kind of weekly income translates to a highly reliable, recurring revenue stream. The market might fluctuate wildly, it might be deep red or bright green, but you can sleep soundly knowing your defined risk parameters are set and your premium is already in the bank.
So, I have to leave you with this final, provocative question. Are you ready to be the house? Because that is exactly what this strategy is all about. Stacking the mathematical odds in your favor, stepping away from speculative guessing, and reliably securing your weekly income. If you found this explainer valuable and want to truly master these exact weekly income strategies, please make sure to smash that like button and subscribe to the Noob Selling Options channel right now. We've got a lot more powerful, profitable frameworks to cover together. Thanks for hanging out with me for this explainer, and I'll catch you next time.